Okay, today's show, I want to talk to you about a plan that I just put together for a client of mine, and it is titled Five Steps to Creating a Seven-Figure Net Worth Investing in Commercial Real Estate. Before I get into that, I want to tell you kind of a quick story about what happened over the weekend, and you'll see how it ties into today's episode. So this weekend I did my second triathlon, second open water triathlon, and it was here in Calgary. Um, it's funny because as I was pulling up this year, I realized just the level of confidence I had going into this triathlon versus the first one that I went into. The first time I went out to Elbow Valley, and it was just a sprint, so it wasn't a long triathlon. It was a 750-meter swim. It was a five or this happened to be a 25K bike, which was unexpected. I thought it was only going to be 20, and a 5K run. So I knew that going in, but when you pull up, as I remember the first year, the triathlon sign-in was to the right, but you had to park down to the left, and you had to park about a kilometer away. And because I was there alone, I didn't have any support. I had a bunch of stuff. I mean, I had a whole bin that I was told to take so that if it rained, that all my stuff would stay dry. But when you've got a bin and a bike and all this gear that you're trying to get to the start line, it must have looked pretty funny because I was trying to hold my bike and put this big plastic bin on my seat and walk it for about a kilometer. Well, I ran into my neighbor actually 2 doors down. She was doing it the first last year as well, and she said, "Hey Shane, why don't you drive up? There's a place that you can pull off to the right and park your vehicle to get all your gear into um, to basically get organized, so you don't have to worry about trying to maneuver back and forth." So this year, instead of parking, I just went directly to that spot and I parked there the entire day. And it was funny because just that simple strategy of knowing where to go saved me about 15 minutes of having to frig around going back and forth. So that was kind of really key. The second thing that helped me this year was the first year I bought what was called like a Farmer Joe, and so for a wetsuit that really means that you don't have any arms. And I was like one of probably two or three guys, and it looked like we all went to the same Amazon store and bought them. Um, I made the argument that it was going to be easier to swim and it wasn't going to be as constricting. But if I'm being honest with myself, it was because that was like $130 wetsuit versus $280 to $400 wetsuits. So it was my first open water swim, and water started getting into the sleeves, and it kind of weighed me down. And long story short, I was off course so much my first year that it took me about 23 minutes, and it should have taken about 20 minutes, which doesn't seem like a lot, but 3 to 4 minutes extra in the water, if you're not planning for that, is a significant amount. And I remember because the first year my wife and kids did come and cheer me on as I was in the water, and I remember thinking to myself, like, I don't think I can make it because it's a course and you have to go twice around. And I really didn't think I was going to be able to make it the second go around. So this year, prior to going into the, knowing what to expect, I wanted to Google videos on how to sight where you're swimming and the best way to kind of be more effective in the water. And there was like one particular video, and in it he described how most triathlon, like average age category swimmers, he calls them, so I would be in the age of 40 to 49, I guess. But really it's like you've got your experts or your pros, and then you've got a bunch of people that are just trying to do well in a triathlon, and that's me. I'm definitely in the second group. So what he talked about was, even though you might get the benefit of following someone and getting a bit what's called I think it's called drag or something to that effect, where your effort reduces by about 8% if you're directly behind. If you're just off to one side, there's a bit more of a benefit that you get, up to 13%. But what he said was, if you end up following the wrong person, what ends up happening is that person is going off course like 80 to 90% of the time. Whereas, because I'm not going to be fast enough to keep up with a professional or an expert, then I'm going to be off course. Even though I'm saving 8 to 13% effort, I'm going to be expending way more because I'm going to be going all over the place. Secondly, I'm not likely going to be swimming my pace, so I might get exhausted trying to keep up with someone that's a superior swimmer. And he said, here's why the average person is off course. They studied a bunch of triathlon swimmers, and what they found was the experts looked up every 6 strokes. So every 6 strokes, you're looking up to see where you're going, whereas an average swimmer is looking up every 28 strokes. So every kind of 30 to 45 seconds, they look up to see where they're at, and that one distinction helped me tremendously. And I mean, I wish that I would have had this watch, this Garmin Fenix 5, my first year, because I would have known exactly how far I swam. But I can tell you on the 2 laps that I did, the first lap, both laps should have been about 375 meters. The first one was 500 meters, which meant I was off course about 125 meters. And then the second lap I did, I was on course even better. It was 460 meters. So I was able to shave off 40 meters just from making sure that I was looking up and sighting properly. So I thought that that was kind of an interesting metaphor for today's show, which is if you're following the wrong person, which is really what happened to me the first year. I was following guys that were like all over the place. I mean, there was boats that are there to kind of protect you and keep you out of the weeds. Well, I was on the outside of them my first year. This year, I was definitely a lot more straight, even though I was a little bit off. But it just goes to show that kind of having that advice and then making sure that I'm following either the right person or swimming my own race really helped me. And so translating that into commercial real estate, I followed the wrong person. And the several times when I first started investing, because I really didn't have quote unquote mentors, I was basically searching, and who I ended up kind of gravitating towards was people that were probably experts at selling from the stage, at talking a good game, presenting, but in reality, they really didn't have the kind of fundamental experience that was necessary to invest or identify what a good property was. So it was very tactical. They were selling their own deals. I didn't know what questions to ask, and it cost me a lot. That one person, and I'm not going to call that person out because they might have been doing what they thought was the right thing. But unfortunately, I lost $30,000 in the first opportunity they presented, and then over $250,000 on the second. And I'm still in that second one, the deal in Costa Rica. If I talk about it too much, I just get way too jacked up because it's very frustrating to know that I could have taken that 250 and knowing what I know now, where that money could, I mean, it would be worth millions today. But, you know, some of those lessons, I guess I needed to learn. And one of the reasons I put this podcast out and these videos is to hopefully show you, like, this is the exact same advice that I give to my family, to my friends, and hopefully you're able to avoid a lot of those mistakes. You'll be able to ask the right questions, and you know, even if you're following someone that is trustworthy, it doesn't necessarily mean that they have the right advice or guidance to be able to advise you on where you should be investing your money as it relates to commercial real estate. Now, I will make a disclaimer. Nothing I'm telling you is advice on what to do. I'm merely sharing my own experience. So I'm not a lawyer. I'm not an accountant. Please don't take anything what I'm saying as gospel, or that you know that this isn't meant to be legal advice. Really, what I want to do is just give you some of the principles that I've learned, that I have gathered over the last over 12 years now. From two of my key mentors. In fact, one of the mentors I was just having a conversation with yesterday, and he's now asking me for I wouldn't say advice because he's a pretty smart guy, but I guess he was asking for advice. He's got a property here and he wants to know what he should do with it and what his options are and how much it's worth. And so I started to make some phone calls, and it's nice to be able to give back to the people that helped me when I first started. So I thought that was kind of just kind of interesting. So today's show, what I want to talk about is this is like what is behind me, and it doesn't matter if you're just listening to the podcast because I'll explain it. But this is a game plan to help a professional that I'm dealing with to over the next 10 years to create a mid seven figure net worth, and he's starting from a very low place. I don't want to give that away because he'll be listening, and it's not important. But what is important is that he's got a very clear and identifiable plan. So we know where he is at point A and where he's going to in point B, and then we just have to fill in the gaps in terms of what is the plan, how do we get there? And that's what I want to talk about. There was a great book that actually, I'm kind of switching gears, but this ties into the plan, and that is Rich Dad Poor Dad by Robert Kiyosaki. And when I read that about 20 years ago, there was a few things that I came away with. One was what's possible, and two was the concept and principles around financial literacy and taking control over my own investing. What was left out of that book, and if you've ever heard Robert talk about it, he says, I don't tell you how to invest. I don't teach you how to do that. Kiyosaki is a thought leader. He's extremely smart, but what he's doing is he's giving you very big concepts. And what I've learned from studying him is that he typically goes out and aligns himself with experts that he trusts to invest alongside with or through. And so what's interesting is after reading that book and then going on my own personal journey for over 20 years, 12 of which I've been in commercial real estate, I had to find my own mentors that I could trust and that were going to essentially guide me to investing in the right properties. So, hey Jeff. So we'll get into today's show in terms of the specifics on this 5 steps to figuring out how to invest and create a 7-figure net worth. And it may seem almost unbelievable, but what I want you to do is just kind of listen and accept that this is a possibility. This isn't overnight. This is a plan for 10 years. So this is starting at what I call T0 in the bottom left axis, if you will. And essentially you're starting with 0 cash flow on a monthly basis. And I just want to see if there's anything else that I want to talk about before I get into it. Okay, I guess, yeah, one other concept that I want to mention. The gentleman I'm helping, he doesn't have $300,000 to start investing. So because this is commercial real estate, I've had to make certain assumptions. I'm happy to explain all the assumptions. I tried to keep it as narrow as possible because the more assumptions, the more unbelievable it could seem. But fundamentally, we're starting out with one commercial property. Could be an apartment building, could be a retail building. I've pegged it at a $1 million purchase price. I'm suggesting that you're going to need 30% down or equity, which is $300,000 to start. And if you don't have the $300,000, what's possible is to, and this is really the book that I wrote, which you can see on here, which is clubsyndication.com. You can go and download it for free. I was doing a free plus shipping where you just paid $7, and I'm still offering that, but if you just want to get the PDF and download it for free to get started, you're more than welcome to do that. I don't know how long I'll keep this up, but at this time of the recording, you can go there right now and download it. So in that book, I give you like my 5 steps to raising capital. And so, for example, with the client that I'm working with right now, let's say he has $50,000. Well, he could go out to 5 other friends and raise the other $250,000. So now he's got $300,000. Or maybe he has $50,000. He finds one guy that has $250,000. See, if you know the right properties to find, raising money is never a challenge. And I know that that's easier said than done, but I'm looking at two properties right now in Houston, one that's 160 some units and the other one that's about 190 units. And what you're going to see, what I talk about in terms of the value add properties that I suggest that you focus on finding, I'm only suggesting you find something that you can add 15% to the bottom line, where the two deals I'm looking at, they're kind of closer to 40 and 50%. So you can see what's possible when you find the right properties. But let's just stick with today's presentation, which is you're going to find $1 million property. You're going to add value to it, 15%. And what I'm saying by that is, we talked about this last time, which is the net operating income, or the NOI. You're going to add 15% to the NOI. So on a $1 million property, you're buying it at a 6% cap rate, meaning it's going to have $60,000 of net operating income. So if you bought the $1 million property all cash, you get a 6% return on that. If all you do is increase the NOI of $60,000 by 15%, you're moving it from $60,000 to $69,000. I'm pretty sure that that's the math. And if you were to apply the same 6% cap rate, you've now taken a building that's worth $1 million and now it's worth $1,150,000. So you can see that if you do this, in this case, you're going to see I've got 10 years on the x-axis, and on the y-axis, we've got your cash flow over time. And I'm going to show you how just 3 steps, 3 properties over 10 years, how you can go from basically your $300,000 initial investment, and it could be with investors, to creating $1.65 million in net worth. So, okay, let me just move back here. So we're going to start with property 1, and in it, we are, like I said, you're going to buy a $1 million property. You're going to add 15% to the NOI. You can either reduce the expenses or increase the revenue. I always suggest increasing the revenue because I really, in most cases, properties are run fairly efficiently, and you might have some cost savings on the expenses, but really I like to focus on where can I add value, right? So that is kind of the primary driver for adding value to the property. So once you've done that once, you found a $1 million property, added 15%, you've now taken your $300,000 initial investment, and because you've added 15%, and because that 15% is leveraged, because you've got debt, now you've created $150,000 of equity. At the end of year 3, this would make a lot more sense if you saw my Excel spreadsheet, but it would also probably confuse some people. So I just want to kind of walk you through it. At the end of year 3, you're going to have an NOI of $69,000. You're going to have collected cash flow in year 1 of $15,600. In year 2, you're going to have $24,600 because you increased the NOI. And in year 3, you're going to have another $24,600. So at the end of the 3rd year, you're going to have a property that's worth $1.15 million. You're going to essentially, if you go and sell it at the same rate that you purchased it at, which is a 6% cap rate, the value is going to be $1,150,000. I assumed a 3% sales commission, so that's $34,500. Your outstanding mortgage, you initially borrowed $700,000. You're going to have $648,000. Your net proceeds are going to be $467,000. So that's your cash flow minus all the money that, you can have your cash flow is $64,000. You're going to have the increased value of the property, and at the end of year 3, this is just one property, you're going to have created $232,300 in a return on investment, which is a 25.81% return on your initial $300,000, right? So $300,000 turns into $232,000 in 3 years, okay? And that's all you're doing is increasing the net operating income by 15%, which if you were to take that over 3 years, so your $232,000 divided by 36 months, you've essentially created $6,452 of cash flow each month. Now, what I suggest is that you roll that money that you got, which is about $500,000, you roll it into property two. Once again, you might need a little bit of extra money to buy for the down payment, but you're going to you're going to find a property that's worth $3 million. You're going to put $900,000 down, and you're going to run through the exact same exercise. Add 15%. At the end of year 6, you're going to end up with a property that you bought for $3 million. You're going to sell the property for $3,450,000. So you've added $450,000 of value. You're going to end up with just under $200,000 of cash flow over those 3 years, and your return on investment will be $697,000, or 25.83%. So once again, you have created almost 26% over 3 years, and all you're doing is you're adding 15%. So the key is to find the right property to be able to add the value to. Now, if you take $697,000 and you divide that by 36 months, you're going to end up with $19,372. Now, the last property you're going to go out and find is a $6 million property. You'll need $1.8 million of equity. You're going to do the exact same thing. Now, what I'm going to suggest is that, just because I wanted to create a 10-year plan, this could have been done over 9 years, but you'll end up selling the property for $6.9 million, or you could, based on the assumption that you're selling it the same as what you purchased it for, and you'll end up with net proceeds of $2.9 million after paying out your mortgage, your outstanding mortgage, as well as the selling commission of $207,000. So those property number 3, you bought for $6 million, you sold it for $6.9, you paid out your mortgage, you paid out the realtors their $200,000. You will end up with $1,655,000 of return on your investment, right? And if you remember, your initial investment on property 3 was $1.8 million. So you're almost doubling your money in 4 years just by adding 15%. So that's the only assumption that we're really making. Everything else remains constant. Now, I get that mortgage rates could change, that you might have to put some money in to add the value. I wanted to keep this as simple as possible because, quite frankly, there's so many variables that you can really push the NOI beyond 15%, that I wanted to be conservative and simple without getting into 50 what-if statements, which is sometimes what you end up seeing. So at the end of year 10, you're going to end up with, if you took the $1.65 million, divide that by 48 months, you're going to end up with $34,000 plus a month. Now, if you just wanted to keep that property and you didn't want to sell it, you would end up with, did I calculate that? Yeah, so you're going to be generating just under $150,000 of cash flow a year, and you're paying down your mortgage $115,000 a year. So, on an annual basis, you'll be between the mortgage pay down and your cash flow, you'll be generating $262,000 a year just on one property. So why did I show you this, and how could it be, how could you kind of replicate that? I think really the purpose of today's show is to show you what's possible, number one. I think when you start to apply numbers to the right properties, and you can see really what's possible without having to double the value of a property in 6 months. But if you stretch it out over 10 years, you find 3 right properties. Each time you're bumping up, so you're getting bigger and bigger, and you just add a little bit of value, 15% to the NOI or the net operating income. You can see really how incredible, like what that does over 10 years, and I think that is that was kind of the main. Like when I showed that to my client, he was blown away. Like he did not realize what was possible. And because I've been in this game for so long, I just take it for granted. So I thought, you know what, instead of taking it for granted, I should probably create a video and podcast on that to show from going from 1 million to $6 million, how to go from a 1 million to a $6 million property in, well, it only takes 6 years to get there, but then how you create over almost $1.7 million in equity in that short amount of time. So just to, if you're interested, I'll tell you some of the assumptions really quick, just in case you want to cross-reference. I used 30% down. I used 4% interest rate, and I valued each one of these properties using a 6% cap rate. I didn't have any allocation to what it would cost to raise the rents. So if it cost you, $100,000 or $50,000, I didn't want to get into that. I did not increase the value. I had no appreciation over expenses or income. And what else? I think those are the kind of primary assumptions that I made. Like I said, I want to keep it very simple. And just to recap today, I think I really want to just emphasize how important it is to find the right person to learn from. Number two, why the right plan that you create for yourself or have someone else help you create is critical, because this is long term, and it's very easy, I find, for new investors to get distracted and pulled in many different directions. So if you are committed to investing in commercial real estate, I would say then focus on commercial, and just realize that I didn't show you like a 6-month plan on how to make $1 million, because frankly, while that is possible, I just spoke with a gentleman last week, a good friend of mine, and they're buying a property. They will flip out of it because they bought a distressed asset, and they'll probably make $5 million in less than 6 months. But you know what? They've been at it for 25 years. And so for me to tell you that that is something that you could easily do tomorrow, that would just be setting you up for the wrong expectations. And frankly, I mean, it is so rare that no one designs a business plan around that. Like, you can't design a business plan, in my opinion, around finding someone that is going into foreclosure that needs cash quick. You get the phone call first, you pull the trigger, everything lines up, and then you've got a buyer on the back end that's prepared to take you at a double. I mean, it happens, but like I said, I'd much prefer to show you what you can take control over and create for yourself with the right properties, right? Just 3 properties, that's it, at 15%. Keep rolling that money, and any cash flow that you get, just pump it into the next deal. And like I said, commercial real estate investing is long-term. When you take that long-term approach with the right expectations, you can see how you can really generate unbelievable wealth and passive cash flow. If that's your goal. For me, that is my goal, which is why I do these shows. So that's it for today. If you want, and you had any questions around maybe how I raise money or how I find the deals, you can, like I said, you can go to clubsyndication.com, and you can just get my book, and it gives you the 5-step framework for investing in commercial real estate. If you have money, obviously you can accelerate it faster because you're not having to go out and raise it. But I can tell you right now, if you were to go into any major center, I would go as far as to say any major city in North America, you will find the wealthiest individuals, and those would be likely business owners and professionals, doctors, dentists, engineers, lawyers. They are creating what I call club syndications to raise money and go and buy commercial real estate. And so I'm showing you exactly what these groups are doing. They don't talk about it. It's not, I don't think that they're trying to be secretive necessarily. Maybe they are. But this is really how they do it. This is how they raise the money. This is how they find the right properties. This is how they see the best properties first. And this is how they grow and grow and grow. And if you want to learn about that, you can just download my book. It'll probably take you, I was going to say 60 to 90 minutes. It's about 60 pages long. But it is very concise and jam-packed with like exact strategies on how I do commercial real estate investing. So that's it for today. I appreciate you tuning in and listening. And if you have any questions, by all means, put them in the comments, and I will if I see enough comments, I'll create the next video on that. So that's it for today. Bye for now.